Hi, I'm New York State Controller Tom DiNapoli. I'd like to thank you for attending the 10th Annual Emerging Manager and MWBE Conference hosted by the Office of the State Controller. As the third largest public pension plan in the country, the Common Retirement Fund manages and invests assets on behalf of over 1 million New York State and local government employees, retirees, and beneficiaries. The theme of this year's conference is Looking Back, Moving Forward. This anniversary is a true milestone in the history of the Controller's Office and the New York State Common Retirement Fund.
I said, from a minority standpoint, particularly African Americans, I don't see them in the hedge fund industry. And so I kind of did some work and I said, of the $3 trillion that's invested in hedge funds, there's less than $2 billion that's managed by institutional level African Americans.
We set out immediately to raise a first-time fund as a first-time firm. It took us 22 months, 250 hour-long meetings or calls to generate 11 investors and raise $436 million. And it was one of the most painful experiences that we've had as a firm.
I will say that I believe this program is bigger than we all initially imagined from a scope and reach perspective. When we set out, we anticipated having 6 to 10 emerging manager partnership relationships, and here we are, very close to 30, and looking to expand that with Mach 3. So it's just really had much more success than I think we even anticipated when we began. When I started reviewing emerging managers was early 2000s. I had been a lawyer before and then was asked to do some underwriting for emerging managers because frankly, some people in the firm I was at didn't want to do it. They thought that doing groups like KKR and Carlyle was sexier, more rewarding. And they say, well, the lawyer understands how these things get established, so he can do it.
Our Emerging Manager program started in 1994 with a $49 million commitment to a single public equity manager. The program has now grown to more than $5 billion in commitments.
Yeah, I think there's obstacles to large pension funds to investing in smaller emerging managers. That was always an easy excuse for a large pension fund to say, we'd like to do something, but it's just not possible structurally. And I think that's where New York Common really showed leadership early on, saying, we're going to figure out a way to do it despite our size and what can be difficulties in underwriting emerging managers. So having that leadership role, and which really showed other large pension funds that they too can do this. New York Common didn't just invest, but also helped others to understand what they were doing and how to really grow the investment dollars that are invested in this space.
The comptroller, when he made his commitment to the space, it was something that was innovative. In fact, our program is called Pioneer. And I think that speaks to the fact that we knew that we were trailblazing.
The predominant LPs engaged in emerging manager programs were large U.S. public pension plans, and there were a handful of them.
10 years ago, I made expanding the diversity of our manager pools one of this office's top priorities. We believe diverse voices and teams create a stronger pension fund for all. Today, the Common Retirement Fund uses emerging investment managers to invest in the public equity, private equity, hedge fund, opportunistic, fixed income, and real estate asset classes.
When it comes to what it takes to generate excellent investment returns, our perspective is that diversity really matters. I don't just mean gender diversity or ethnic diversity, we really think about cognitive diversity. And anyone who knows the three of us will tell you that while we do get along well and admire each other, we're really different people. So when we come to the table, at this very table, to talk about how we're going to go about generating these returns, each of us will offer very different perspective.
Our first fund we closed in 2011, and New York Common was our largest investor in that fund, and our first public pension investor. That fund was $230 million, and once we were able to prove the point that the market we're investing in is significant and growing, they were great partners and they backed us, and it still will remain our largest investor.
We were granted mandates that we otherwise might not have gotten, but for the fact that there were thoughtful people, leaders, who said we do have a responsibility first to our beneficiaries to achieve the highest return possible. But that shouldn't be in conflict with being inclusive.
Their Emerging Manager program has been consistent, it's grown, and I think were it not for their leadership, I'm not so sure funds like mine would even exist.
Our experience with the New York State Common Emerging Manager program has been fantastic. We've been made better by the process and the due diligence that was done upon our firm. I think that we were really put through our paces, and we had to be very, very tight and good at what we were doing.
So I think CRF has been extremely helpful in the development of our firm in a couple of different ways. Obviously, one is the obvious, by being there early through the Emerging Manager program in our early funds, those were invaluable commitments. And those commitments over time, we were able to leverage a number of different ways, not only the amount of dollars, but also having that stamp of approval, so to speak, from CRF has been very helpful. Basically other investors notice that and gives them probably some comfort in terms of, kind of following along, or at least saying, well, somebody did their work. We still have to do our own work, but at least there's some comfort level that comes with that.
Preqin, which is a notable database, put out a report on first-time funds and how first-time funds over the past 15 years have outperformed all other funds in private equity, and how the lower end of the market outperforms the upper end of the market.
An African-American owned firm will be emerging for a long, long time. Whether it's 1 billion or 10 billion, compared to the industry, the money management industry, we are very small.
We have 10 portfolio companies. And if you look across the portfolio, we've generated something like 1,000 jobs. Some companies have grown their portfolio meaningfully, about 40 to 50% in terms of actual employee job creation growth. There have been several that have brought jobs back to the United States that they had been outsourcing, as being able to manage the service and the product they were offering was more effective and actually more cost effective to onshore those jobs. And we have not had a single company that's had any loss of jobs.
This is one of the things that we at HarborVest are most proud of. We started about 15 years ago tracking data in terms of the types of jobs that were created at our portfolio companies through the managers in which we invest. And today, looking back at the last 10 years, we can proudly say our portfolio companies have created nearly 900,000 jobs. And of those jobs, about 67% or 2/3 of those jobs went to diverse individuals. The small and medium-sized businesses are the fuel for the U.S. economy. And we're excited to be participating in that job growth.
So we have invested in companies that employ tens of thousands of folks here in the U.S. Within our organization, we are now more than 50 people at Brightwood, but it's really the portfolio companies that we touch and the companies we invest in that really gets us very excited to every day to come into the office and to do what we do. And we take incredibly serious the partnerships with these companies, because they're the mid-sized companies and the growth engines of our economy.
Over the last 20 years, the CRF has graduated more than 20 managers from the Emerging Manager program, including 14 MWBE firms or firms substantially owned or operated by minorities or women, into the pension fund's core portfolio.
One of the important lessons we've learned, having invested in the emerging manager space for many years, team history is critically important. It may not be a conventional team history, but we realize that these are 10-year partnerships. Making sure that the folks who are starting the new firm actually really know each other and understand what it's going to be like to work together is really important to the success of the firm.
Organizationally, we're long-term focused. We're long-term investors. And so we're not looking to try and figure out what the market is going to do over the next quarter or 2 quarters or even over the next year. We go out, we unearth what we call exceptional growth companies that we think have the wherewithal to become exceptional larger companies, and we invest in them.
We know that we don't have an advantage over anybody else in predicting where the S&P is going to go next year or the price of oil or things like that. So we're very disciplined in sticking to our knitting and what is it that we do well and what do we not do well and don't participate in those areas.
I can tell you from our experience, we've seen in the past other firms and even firms that we've worked for fall into the trap of trying to go into spaces where they did not have a particular expertise. And I think that that's something that we learned through our careers, and that's one reason that when we started BCK, we wanted to be very focused on the things where we did feel like we had an edge.
I have been actually attending the conference, the Emerging Manager Conference that CRF has organized now for several years, and that has actually also been extremely helpful because that was an opportunity to interact with other investors, with obviously the staff at CRF, but also other potential LPs and investors in our fund, and also get a lot of feedback about kind of how institutional investors, particularly public pension plans, look at the world, what they're looking for in terms of a firm.
When we're reviewing private equity firms on behalf of New York State Common and others, we use a lens of what we call PSEA, people, strategy, execution, and alignment. And what's interesting about that is that we can turn that same lens on ourselves and think about, okay, we're reviewing managers for the program, but we're also being reviewed at times. And so when someone's reviewing us, how are they viewing the people? Are we consistent with our strategy? And how do we execute our strategy? And are we aligned in terms of being partners in this and less of a vendor relationship, but really about being partners?
The goals of staying abreast of the latest thinking and exploring creative approaches continue to drive our Emerging Manager program. The success of this program contributes directly to ensuring the financial futures of our members and pensioners, our most important fiduciary duty.
The fact that our capital comes from retirees in the New York State system is actually something that differentiates us from other funds who people have different views of the private debt and private equity, and when they really cut through it and they see that we're partners with folks who are their friends and constituents, it really changes the dialogue.
Their validation is why we've been able to attract a significant amount of capital from other investors. Their validation in the business model and then us as people has been really important.
In some respects, the best of times and the worst of times for emerging managers. I think that the market is very competitive. Clearly, there's a lot of very smart people that have raised funds that are looking for deals. Valuations are interesting. You can argue they're fairly high, based on historical levels. However, there's always an opportunity for a small or not so small firm that has a differentiated strategy, that has conviction, and that is more nimble, that can basically identify and capture those opportunities quickly. There's always opportunities for those type of investors, I think.
All of our emerging managers share a relentless drive to succeed. Failure is just not an option, but success is dependent upon greater access to capital.
There's a whole lot of interest with state public plans, the federal government now, and corporations that all have an interest in looking at smaller and emerging funds. And that has kind of raised the bar for everybody, which is generally a good thing.
I think my best advice to other firms would be to make sure you have a differentiated process and a differentiated story. Me Too won't work in this day and age, especially with the amount of competition we have, not only amongst each other, but also from the indexes that are out there.
Don't be afraid to take a risk. When I started my firm, I had no idea how hard it would be. In hindsight, I would still do it all over again. It took twice as long and probably cost twice as much, but it's been very rewarding.
Going forward, our Emerging Manager program will continue to strengthen the fund's value, access new talent and investment opportunities, and open doors that may have been shut in the past.
The Emerging Manager program has made an enormous impact on me personally, as well as many of the firms out there. But from an economic standpoint, there's been a lot of wealth created for plan sponsors, for managers and their employees, and I think it's a there's a trickle-down effect for our economy.
It's still in the very early innings of development, so I would say there's a lot of opportunity.
As we assess where the program stands now, we have great reason to be proud. More importantly, we have even greater things to look forward to.
People may have looked at emerging managers with a lens of skepticism in that, we might be seeding an opportunity, we might not expect to get our capital back or necessarily a market rate investment return. I think that paradigm has completely shifted in the world that we live in today, in that I think large institutional investors here in the US and around the world have recognized the fact that there might be room to invest with emerging managers that create just as much impact and return as some of the other more traditional investments that they've historically made.
There still are many, many other large public pension funds that are just starting to dabble and haven't made the same level of commitment as New York Common. And we see our group as kind of at the tip of the spear there. And what do I mean by that? As we demonstrate our success, that we can partner with and invest with emerging managers and generate fantastic returns, which we're doing so far, knock on wood. I think the word is going to get out, and it's going to be there as kind of proof that you can be successful partnering and investing with emerging managers.
But another thing I think we've all been doing throughout our careers is having really an open door policy, even if somebody might not be ready, not have all those factors that make us comfortable investing today, that we're all absolutely willing to spend time with them, to give them, constructive feedback, to even brainstorm about, ideas that could help them become stronger and be ready for that institutional capital. And I think that's really an important piece of, sitting on this side of the table is you're building the community at every stage, which includes some coaching at the early stages.
If it was that hard for us, how hard would it be for others? And could we create a new source of capital that didn't exist in the industry before to help other firms, other emerging managers, develop a track record by investing deal by deal in joint ventures and building a track record to ultimately raise their own fund? And we created, thanks to the team, a Artemis Emerging Manager program whereby we take 18 two-thirds diverse young college students after their sophomore year and expose them to everything real estate. Over the last 4 years since we've started, we've trained close to 50 interns, majority diverse, and are now helping them to access job opportunities in the real estate industry. And what we're hoping to do, and what our emerging managers are now doing, is paying it forward.
A lot of people dream of success, and other people wake up and work hard at it. Every day you got to have this work commitment. We don't glide, we work hard every single day.
I'm a better investor today than I was 10 years ago, and I would like to think that with age comes a little wisdom, but a lot of that has also been through my interactions with my colleagues, my peers, my partners, but also my junior colleagues, my folks that have joined the firm in the past 10 years, that have each one of them added a little component to the firm, has made Clear Lake a better firm. And that has been a key component to us, that kind of sense of continuous improvement, and always thinking that there's something else to learn, there's always something to improve. And we haven't lost that, and I hope we never do.